Hello friends, welcome to this deep dive into the ownership and legal forms of microfinance institutions or MFIs. Around the world, millions of individuals rely on MFIs for financial services. These institutions play a pivotal role in empowering low-income populations, supporting small businesses and driving economic development, especially in developing countries. The ownership and legal structure of an MFI are fundamental to understanding how these institutions operate. These factors influence the governance, regulatory, compliance, funding strategies, and mission of MFIs, which can range from non-profit organizations to fully commercialized banks. The choice of ownership model and legal form determines the institution's ability to raise capital, expand operations, and balance the social mission with financial stability. Today, we will explore how these institutions are structured, how they are owned, and what legal frameworks shape their operations. Understanding these can provide insights into their ability to grow and serve those excluded from traditional banking systems. Here, we will explore the basic functions of MFIs, the evolution of the microfinance sector, and how the ownership and legal forms of these institutions shape their strategies and impact. Understanding the different ownership models, including NGOs, non-banking financial institutions, cooperatives, and microfinance banks, provides insight into the strengths and challenges faced by MFIs in achieving their goals. So now let's start with ownership structures and MFIs. MFIs operate under various ownership structures, each bringing different strengths and challenges. Let's take a look at these models. Starting with non-governmental organizations. The first and perhaps the most fundamental ownership model is the non-governmental organization or NGO model. These MFIs were the pioneers of microfinance, with institutions like the Grameen Bank in Bangladesh leading the way. NGOs often prioritize social impact over profitability. They are funded by donations, grants, and concessional loans, but face challenges like limited access to capital market and scalability. The strength of NGOs lies in their deep connection to local communities and their mission-driven approach to poverty alleviation. However, the reliance on donor funding makes them vulnerable to external pressures and expansion can be slow. Next, we have NBFIs or non-banking financial institutions. These institutions provide financial services but don't hold full banking licenses. NBFIs are more commercially oriented than NGOs. They can mobilize savings and offer a broader range of products, and because they are regulated, they tend to have better governance and financial stability. However, with a greater regulation comes higher operational costs. They also need to maintain financial sustainability, which can sometimes conflict with their social mission. Then we have cooperatives and credit unions. These are member-owned institutions where the clients themselves hold shares and have voting rights. These institutions focus on collective ownership and democratic decision making, often in rural areas. Their strength lies in community involvement and the direct benefit members receive. But the very structure that makes cooperatives strong also limits their ability to expand quickly. They rely heavily on their members and may face governance challenges in leadership. Isn't it accountable? Microfinance banks are another key ownership model. These are regulated banks with full banking licenses and the ability to offer a wide range of financial services. MFBs can mobilize savings, access commercial capital market and grow quickly. But with the ability to scale comes the challenge of balancing financial returns with social impact. These banks are subject to the same regulatory scrutiny as commercial banks, which ensures financial stability, but they may face pressure to focus more on profitability than their social mission. For profit versus non-profit models. Finally, MFIs can also be categorized as for-profit or non-profit. For-profit MFIs aims to generate returns for investors while still serving low-income populations. Non-profit MFIs focus on social outcomes, often at the expense of financial stability. While for-profit institutions have better access to capital and can scale rapidly, they may face criticism for prioritizing profits over their social mission. Non-profits, meanwhile, often struggle to grow due to their reliance on external funding. Now, let's move to the legal forms of MFIs. These forms vary by country and directly affect the services MFIs can provide. NGOs, MFIs are typically registered under national law governing non-profits. They are often exempt from taxation but face restrictions on offering certain services like accepting deposits. NGOs are mainly limited to providing credit services unless they partner with regulated entities. They are accountable to donors and often struggle with scalability due to regulatory constraints. NBFIs operate under stricter financial regulations. They must adhere to capital requirements and prudential norms, giving them greater flexibility than the NGOs. While these institutions can offer more diversified services, they must comply with financial stability requirements, making them more expensive to run than NGOs. Microfinance banks operate under full banking regulations and are licensed to offer a range of services, including savings mobilization and interbank lending. These banks are subject to the same rules as commercial banks, such as capital adequacy and consumer protection laws. This makes them highly scalable but also susceptible to mission drift. Finally, cooperatives and credit unions. They operate under legal frameworks that govern cooperative societies. These laws ensure that member ownership and democratic governance remain central to their operations. While cooperatives are highly community driven. They face limitations in product offerings and expansion due to their focus on serving the members. The landscape of MFIs is evolving, initially dominated by non-profits. We now see a shift towards commercialization and digital transformation. As donor funding becomes scarcer, more MFIs are moving towards for-profit models. Additionally, governments are introducing more regulations to protect consumers and ensure financial stability. Now let's look into challenges in ownership and legal forms. Despite their critical role, MFIs face several challenges. For instance, commercial MFIs risk mission drift as they balance social impact with profitability. They also face regulatory burdens that add to operational costs, especially as they scale. Access to capital remains a challenge for NGO-based MFIs, limiting their growth potential. Let's now look at few case studies to better understand how ownership and legal form shape the impact of MFIs. Grameen Bank in Bangladesh operates as a community-owned MFI empowering millions of women. SKS Microfinance in India transitioned from an NGO to a for-profit but faced accusations of mission drift after its public listing. Finca International operates a hybrid model combining social mission and commercial viability across multiple countries. Global MFI distribution pie chart. Around the world, NGOs make up 40% of MFIs, followed by NBFIs at 25%, banks at 20%, cooperatives at 10% and others at 5%. This distribution shows the diversity of ownership forms globally. As we have seen, the ownership and legal forms of MFIs greatly impact their ability to provide financial services to low-income populations, whether NGO, NBFIs, cooperatives or banks. Each model has its own strengths. Different ownership models such as NGOs, non-bank financial institutions, cooperatives and microfinance banks offer various advantages and face unique challenges. While NGOs prioritize social impact, they often struggle with scalability and access to capital. NBFIs and MFBs, on the other hand, have greater access to commercial funding and can scale more effectively, but they face the challenge of balancing profitability with their social mission. Cooperatives emphasize community ownership and democratic governance, but they face constraints in capital mobilization and even expansion. The legal form of an MFI directly influences its regulatory requirements, service offerings, and sustainability. Strong regulatory frameworks are essential to ensure consumer protection, financial stability, and alignment of MFIs with their mission of serving low-income population. Understanding these ownership and legal structure is key to evaluating the effectiveness and impact of MFIs in promoting financial inclusion. Thank you all for joining us for today's session. Let's meet you in our next interesting session. Until then, stay tuned, stay connected.